Good afternoon, everyone. David Rodriguez again, quantitative strategist for Dailyfx.com. Thank you. I see a lot of the same faces from even 9 a.m. this morning. So really appreciate the support, a vote of confidence. I think we've been going through a lot of stuff, and some of it will get repetitive, but repetition isn't necessarily a bad thing if you're trying to drill something home. And really what I'm personally trying to drill home is that, and I've said this a couple of times now, the numbers don't lie and the numbers aren't necessarily pretty. And at the end of the day, a lot of the times, or the numbers show that a lot of traders lose money. So at the end of the day, you really want to have a really good sense of how you can become more successful at trading and avoiding, again, the numbers don't lie. There are common pitfalls that you want to avoid to give yourself the maximum chance of success. So this presentation, just to give you a sense, if I had to reschedule everything, I would put this one after my Asia trading one, and you'll see why in a second. But basically, this presentation is just going to go over the fact that there are a lot of times when you should avoid major currencies. And the reason for that, we discussed it a little bit if you saw my earlier presentation. If you trade like most of our clients do, if you're a range trader, it's a good idea to avoid really volatile markets. Now, that means that you avoid currency pairs where volatility is super high. It also means that you avoid trading during certain times of the day. The title of this presentation is Trading the Major Currencies During Active Hours Without Getting Burnt. And basically that's what we're going for. We're going for rules that can allow us to trade volatile currencies, so when we turn the other system off, we can turn this one on, and you can have a complete trading strategy. So before we get started, always the risk disclaimer. Please understand that whenever you're trading with leverage, there is significant risk involved. So just as easily you can make a lot of money, you can just as easily lose a lot of money. And whenever you're trading with leverage, please only trade with risk capital. So trade with something that you can afford to lose. This is especially true if you're new to this market, where it's difficult to just start out of the gate on a strong note. So it's really important to get your bearings and understand the market before really trying to push your luck, so to speak. There's also the hypothetical disclaimer. I'll be talking a lot about hypothetical performance back tests of specific trading strategies, and all of this I truly believe in. All of this, it's really easy to cherry pick examples, and obviously I'm not going to show you something that doesn't work, and I really believe that these do have a chance, but I'm by no means omniscient. I coded these and I looked at these back tests with the benefit of hindsight. So anything that's worked in the past isn't guaranteed to work in the future. Please do your homework. Please control your risk. So, as I mentioned in my intro, looking at the raw data, the raw data doesn't necessarily paint a flattering picture for your average Forex trader. And the chart here, if you saw my earlier presentations, you've seen before. But basically what we're looking at is profitability per currency pair per quarter. So we have the 13 most popular currency pairs, 13 of the most popular currency pairs traded on FXAM platforms, and each of those bars represents the percentage of traders who traded that currency pair and made money through that quarter. We have 4 different quarters here, Q4 2009 to Q3 2010. Notice the dotted line in red. The dotted line in red is the 50% mark. So if anything is above that, it means that most traders actually made money in that quarter trading that currency pair. Unfortunately, all of those lines, with the exception of the Aussie Kiwi and one with the Euro Sterling, are below 50%. That is to say that more traders lost than made money. And really what I've been trying to get at this whole day is understanding why that might be the case and understanding how we might make that better. Obviously, again, if you're just interested in the thrill, there's a nice roulette table, a nice blackjack table, and you got free cocktails. Here, you come to Forex, you start trading because you're interested in making money. One interesting tidbit, and this was really one of those aha moments. I've been poring over this data for a long time now. It's something that I've been paying a lot of attention to. I mean, honestly, I work for a research website where we advocate Forex trading. And if most of our clients are losing money, that bothers me. If I can look at the data and identify common pitfalls, that means that our traders have a really much better chance at avoiding those common pitfalls and actually making this worth their while. One thing we see, this is a really interesting chart, and again, this is one of those aha moments for me. It's profitability per currency pair per hour of day. So these are the top 5 traded pairs on FXCM platforms. We have the euro dollar, sterling dollar, dollar Japanese yen, Australian dollar, US dollar pair, and US dollar Swiss franc. And basically, what we're showing here is the percentage of traders that made money on open trades in that particular currency pair per hour of day. That 50% dotted line, below that, more traders lost and gained. Notice really clearly that there are a lot of hours in the time of day that most traders are actually making money. But also notice the fact that there's even more time during the day that clients are not making money, and actually most are losing. So obviously this data is significant onto itself. It's the first time that FXCM is really making this data public, and it's really great to know. But just looking at this in isolation and not really understanding the why or the how does this make sense? More importantly, how do we fix it? Really need to understand something about volatility and, again, how our traders trade. Now, I had mentioned earlier that if I had the chance to reschedule this, I'd put this after a presentation I'm making later today. So I'm going to summarize really quickly what I'll cover in more detail today at 4 p.m. But basically, what we're dealing with here is what we talked about at my most recent presentation about volatility. Volatility is, behind money management is probably the word I'll use the most, or the phrase I'll use the most today. Why? Because volatility is really significant and really makes a difference on your trading strategy on your actual trading account. And what we have here is a great chart. So we have the average hourly move in absolute values. So I don't care if it went up or down. I just care that it moved 50 pips within that hour. Per time of day in Eastern time. And what we're seeing here is during the U.S. session, which especially if you live on the East Coast, is probably when you're doing most of your trading, notice the fact that there's really high volatility in the morning. Really high volatility in the morning, especially when there's an overlap between the London trading session, which runs approximately until 10 Eastern, 11 Eastern, or 11 Eastern to 12 Eastern, and the U.S. session, which starts at approximately 8:30, 9 a.m., depending on how you measure it. Notice the volatility is super high in the morning, tails off throughout the rest of the day. Notice something else. This is a London trading session. Through London, London opens at about 3 a.m. Eastern time, goes to about 11 a.m., 12 p.m. Eastern time. And notice that volatility is really high through these hours overall. It's actually overall the most volatile session of the day. Now, it won't surprise you to note that volatility has a lot to do with average client profitability. And if you went through my earlier presentations, you'd understand that the RSI, or we'll talk about, let's not put the cart before the horse, but given the average profile, or given the profile of the average client, they're going to do better when volatility is very low. You want to avoid situations like this. In fact, some of the best times to trade are probably going to be during the Asian trading hours. Volatility is substantially lower, and you can use this to your benefit. You can say, I'm not going to trade a low volatility strategy when volatility is too high. Sure enough, when you limit yourself to Asia trading hours, you might do better in certain strategies. So we'll go back to the example that, behind money management and volatility, I would probably say RSI a gajillion times today. And really what it comes down to is that I firmly believe that RSI covers the average trading style, the trading profile of the FXCM client, which if you believe that the FXCM client is indicative of the retail trading client, you believe that there's something to this. And what we talked about earlier, pretty simple. The RSI trading strategy, I'll go over it just so you're aware. RSI is very simple. You're selling something that's rallied too far. You're buying something that's fallen too far. You're selling something overbought, buying something oversold. works really well when markets don't go anywhere. And that's exactly what we have here. You know, the euro's broadly trading higher, but it's mostly just trading in a super choppy range. Great. Breaks out. Terrible. What are we going to do when we know that it does poorly in these times of volatility? We go back to our earlier example, and we know volatility is fairly predictable throughout the day. We're going to limit ourselves to certain hours of the trading day with this strategy. So this is the performance of the RSI trading strategy on the Euro-US dollar, sterling dollar, and dollar Swiss franc pairs on a 60-minute chart, approximately from 2002 to 2011. I think I drew this chart about 3 weeks ago, so it doesn't have the most recent price action in there, but it's up to just recently. Overall, strategy is pretty terrible. And looking at, if I had the breakdown between currency pairs, you'd see that the euro dollar and the sterling dollar are especially poor here. The dollar Swiss is a little bit more consistent. Regardless, we're going to institute that filter and say, I'm only going to trade that volatility, or I'm only going to trade that low volatility system when I know that currencies on average move less. And this is what we have here. So I'm flying through this, but again, I'm going to cover this in further detail today at 4 p.m. and in my Asia Trading Hours presentation. But basically what we have here is, again, the line in blue is the baseline strategy. The RSI strategy across those three currency pairs, 60-minute chart, going back about 9 years. And then those other currency pairs are limiting ourselves to trading during those hours. Notice the fact that we actually achieve some of the best results trading the RSI trading system from 14 Eastern to about 6 Eastern, which means from about 2 p.m. New York time to 6 a.m. New York time. If we limit ourselves to these trading hours, and this is particularly true for European currency pairs, which again are most volatile through the Europe session, we have a better chance of success just trading a plain vanilla range trading strategy because markets are likely to move less. Because on average, European currencies don't really see major moves through the bulk of the Asia trading session through early European hours. Again, the most volatile period of the trading day is approximately 8 Eastern time to 10 a.m. Eastern time. That's a crossover between London and New York. That's when we see the biggest moves. We want to avoid those strategies if we know that our system doesn't do well when markets are moving a lot. So here we are. I'll cover this in further detail a little later, but I just want to put it out there just to emphasize that if you know that volatility fits a certain pattern and your trading strategy is particularly susceptible to it, avoid it when London traders are on and New York traders are on at the same time. The next thing we covered, and this is again just a brief recap of what we've already covered about the RSI, volatility expectations. So just to summarize again, volatility plays a huge part in the SSI and in the RSI, and given that the RSI, in my experience, in my opinion, is a great proxy for what the average retail client does, you want to pay attention to when this benchmark range trading strategy is going to work. And we talked about this earlier. The RSI trading strategy was fantastic in 2009 because volatility was contracting. And these volatility indices are drawn from FX options markets. FX options traders put a lot of money on the table and basically bet that this option is going to expire with more value than or produce a profit for them. One of the biggest drivers of options prices is volatility. If we can draw those numbers, we can see what they believe currencies are likely to do. Again, when these volatility expectations were contracting, 2009, range trading was great. When that broke out, range trading was terrible. So we went back to my weekly report, these volatility percentiles that I discussed a little earlier. Volatility percentiles is just telling us how volatile options traders expect the currency pair will be compared to what traders were saying in the past 90 calendar days. So approximately the last quarter, traders are saying, in this case, the Euro Swiss franc is about in its top 10th percentile of volatility as compared to the last quarter. It means that the Euro Swiss is probably going to show major moves, want to avoid range trading this. And this has a really strong correlation, again, with the average client. And, if nothing else, I want you to realize that there are certain things we see in this data that can really help us understand how we can improve our chances. One of the biggest things, again, if we model the average retail trader as a range trader, we can say, if volatility is too high, you want to avoid that currency pair. Sure enough, the data bears that out really well, better than I personally would have expected even. And when that volatility number is in its top quartile, so from 75 to 100% approximately, traders tend to do really poorly. That's that big average loss. To explain this chart a little bit better, again, on the x-axis, you have that volatility percentile. From 0 to 24, or 1 to 25, that's 1, 25 to 50 approximately, 2, 50 to 75, 3, 75 to 100 is 4. When that number is in its top quartile, traders do really poorly on average on the euro-US dollar. When it's in its bottom quartile, traders tend to do pretty well. Solution, in my opinion, avoid it when it's really volatile. And beyond that, you want to understand why traders tend to do really well when it's not volatile. And the average trader tends to range trade. So again, we take it back to our example, and I'll show the equity curves in a second. But if you recognize that you're a range trader, avoid the euro-US dollar when that currency is really volatile. Look to trade it when it's less volatile. And this is actually remarkably consistent across currency pairs. I think the euro-US dollar looks better than I could have predicted given that study. But the sterling dollar shows a similar profile. I mean, when volatility is in its lowest quartile, traders actually tend to do pretty well in the sterling. When it's very high, on the other hand, it's much worse. And the average trader loses money. So again, we brought that back to our range trading system, the RSI, and we said, all right, we know it's going to do well when markets aren't going anywhere. We know it's going to do really poorly when the markets break out. What do? The strategy cannot enter a trade when volatility is too high, and it must close the trade if it's in a trade and that volatility number goes through the roof. So what did that look like? This is the baseline trading strategy performance across those 4 currency pairs from 2003, give or take. And when we added that volatility filter, especially when we limited our system to only trade the RSI when that percentile was below 25%, that's when we had the best risk-adjusted returns. I know this chart is very noisy, but again, that blue line is the baseline, the RSI strategy across those 4 currency pairs. And then that percentile, if that number is above 75, we cut it off, we close trades. Above 50, we cut it off, we close trades. Above 25, we cut it off, we close trades. And that's what we see there. I know that green line doesn't look very sexy. I'll be the first to admit it. It's less than half as high at the very end as the blue line, which is our benchmark. But at the same time, those peaks and troughs are a lot less pronounced. It looks a lot more consistent. If I were trading, I would much more have consistency than the biggest peak, because the biggest peak, the highest you rise, the higher you have to fall. And that's what the data bears out. Past performance is obviously no guarantee of future results, but for the most part, I think this gives us a really good sense of when strategies like RSI, like any range trading strategies, are likely to do well. Again, we want to avoid the major currency pairs especially, and this is a study across the 4 biggest currency pairs. We want to avoid them when that volatility number is super high. I'll bring you back to that summary table just now. Again, most traders tend to lose money on the sterling dollar when that volatility number is above 50. They tend to make money, if only a little bit, under 50. It's remarkably consistent in the euro-US dollar. Keep that in mind. So now that we've done a brief recap, and I realize that I didn't cover the Asian trading strategy in full detail yet, but now that we've done a brief recap of what trading with volatility means, the natural question is, obviously, I could just leave my computer alone, sure. But it's human nature, and volatility can stay high for really long. You mean to tell me that if that number is above 25, I shouldn't trade a currency pair? No, that would probably be a little unreasonable for me to say. A, because there are good opportunities there. B, because you're out of the market 75% of the time, which is, in my opinion, fairly unreasonable. What I want to take you to now is then, if range trading doesn't work in these market conditions, what do we do instead? If we know that our system is going to do poorly, if we know on average that the average retail client loses money during these times, what do we do when we are in those times? Do we just avoid trading altogether? No. And something I want to talk about is a very simple strategy. And I like making it as simple as possible because there are as few moving parts as possible. It's just way easier to understand, and it's way easier to absorb that information and really use it in your trading. So this is one of my favorite super simple strategies. It's called channel breakout. Channel breakout, you draw a channel. The channel is highest high and the lowest low in the past X number of bars. In my example, I use 20 bars. That's a fairly common input. So I draw the highest high and the lowest low of the past 20 bars, and that's my channel. So my buy rule is very simple. When price breaks the highest high of the past 20 bars, when it breaks my channel and it forms a new high, I'm going to buy. The sell rule is really simple as well. When it breaks the lowest low, I'll sell. Does pretty poorly when price isn't really going anywhere. And I apologize, it's a little difficult to see exactly what's going on here. But if you can squint your eyes a little bit, you can see these little red connecting lines here. And when those connecting lines are red, it means that those hypothetical trades were losers. You can see why they probably were losers, because it was buying at a really high price. It was buying it when it was expensive. And if it pulled right back, it was going to lose. Strategy does pretty poorly. When does it do well? Sure enough, we're talking volatility. Shouldn't surprise you to know, it does well when there's much more volatility in the market. These are great examples. When this particular currency pair starts moving big, the channel breakout strategy tends to do well. So, just like we did with our range trading strategies, we're going to try to say, I want to avoid that period where price isn't going much anywhere, because I know that this system isn't going to do well. When I'm buying something because I believe it's going to continue rallying and it pulls right back, that's pretty much a recipe for losses. If I can avoid it, I'm going to avoid it. So, what does the channel breakout strategy look like across all these currency pairs? So here I have the most popular traded, most of the most popularly traded pairs on FXCM platforms: the Euro US dollar Swiss franc, sterling dollar, dollar yen, dollar Canadian dollar, Australian dollar, and New Zealand dollar. And I'm doing that 20-period channel breakout strategy on a 60-minute chart for each one of those trading systems from 2005 approximately to present. And I'm trading one 10K standard lot per trade on each of those pairs. So if I were starting with one-to-one leverage, I would start my account with approximately 70,000 US dollars. This is the hypothetical return. These are the hypothetical returns of that strategy across these 7 currency pairs throughout that stretch. We can see that, especially in times like 2008, the strategy does fantastically well. If you're buying something because it's super expensive, it broke its highest high, and it continues higher, you're going to make money if you know how to manage the trade properly, and the pair continues in that direction. That's a big if, though. You need to understand that sometimes that's just not going to work. So, again, we're trying to avoid times of low volatility. Let's see what happens when we start adding that volatility filter. And just to reiterate, just because something's worked in the past doesn't mean it'll work in the future. I mean, the big thing with hypothetical data is that I did this with the benefit of hindsight. So sometimes, again, I believe that this will work, but I'm by no means omniscient. So please be aware that there still are risks and could be pretty substantial risks. That said, let's see what it looks like. All right, so I'm going to limit myself to trading only if that volatility percentile is above 25%. Actually, that's pretty terrible. That's far worse than the benchmark trading strategy because we miss a lot of this good breakout kind of trading regime from 2005 to late 2008, give or take. And if we limited ourselves to just when volatility was above 25%, we would have done pretty poorly overall. The risk adjusted doesn't really improve very much. You do see a smaller drawdown, that's true. But at the same time, it doesn't floor me. It's not really doing a great deal for me. Let's try again. All right, let's limit it to 50%. Again, it's just not impressive. The fact of the matter is that if we went back to our filtered RSI strategy, if we did the 50% filter, it didn't work great there either. But if I had to choose between the RSI strategy and this at 50%, I would take the RSI strategy because this is just generally pretty mediocre. Let's keep going. 75%. Okay, now we're starting to talk a little bit here. It doesn't go as high as the benchmark, sure. But you do see the fact that, and it's difficult to see and I apologize, but let's try and zero in right here around 2008, which was basically when Lehman went bankrupt and when Bear Stearns went bankrupt. Well, Bear Stearns way before Lehman, but once Lehman went bankrupt, markets went insane, and you saw major breakouts across major currency pairs. You saw that in the channel breakout strategy. It did extremely well, and our volatility filter basically said, markets are going berserk, let's trade breakouts. Sure enough, our filtered strategy takes almost full advantage of that move. The thing I want to point out is that the unfiltered strategy takes a real beating very soon after. And really the reason for that is that volatility contracted substantially. Even though it was sky high, volatility tends to be mean reverting. So even though trading conditions are extremely good for it right now, maybe that means that in the next couple months it's not going to do as well. And sure enough, we would have easily lost everything we had made leading into the preceding 5 years just in a little bit of time. And that 75 percentile, though not perfect, and this takes that volatility percentile on a daily basis, so it will be delayed. But at the same time, it saves us from a lot of that drawdown. And going to the extreme, I only want to trade this system when that volatility percentile is in its top decile, in its top 10%. When that number is above 90, I want to be trading breakouts. And that's what that purple line is. And I apologize if it's a little difficult to see. But basically what we're seeing is that overall, it's not nearly as sexy as the blue line. The blue line is a completely unfiltered strategy. But at the same time, you do see that it's a lot more consistent. I mean, it stays out of the market the vast majority of the time. In theory, about 90% of the time, it's not in a trade. But when it is in a trade, I mean, you do see that you do get a lot of the benefit from that major breakout 2008. And since then, it hasn't really lost very much of that profit. So this is the kind of system where I kind of like as a counterpoint to my RSI system, to my filtered RSI strategy. So when I say that it's a bad time to trade a range trading system, maybe I start to look at a channel breakout system and channel breakout as a general benchmark for any breakout strategy, because I could fit a number of strategies in there. But this is probably the simplest one. It tends to do pretty well when that volatility percentile is above 90. And though I don't really discuss it to the same extent as I did in the earlier range trading with volatility, the RSI with volatility strategy, using these volatility percentiles, which again are based on FX options, is a lot better than just using most indicators. Again, it's really important to keep in mind when traders tend to do well, when traders tend to do poorly. Avoid currencies that are moving a lot if you're just going to try to sell at resistance, buy at support, because you're going to fall into the herd. And the herd tends to get hurt pretty bad when that volatility is really high. And really, obviously as a pejorative term, you're part of the herd, you're just kind of wandering with the rest of the crowd. But you want to pay attention to this because, again, this is kind of damning data in a lot of ways. Like, you're seeing that a lot of traders tend to do pretty poorly. But if you can understand that why they do poorly and try to fix it, that goes a long way into giving yourself a much better chance of success. And again, I think that volatility is one of the big reasons why traders tend to do poorly sometimes. Recognize which strategy works best in which trading environment. If you are a range trader, like the average client, you are probably going to do poorly when it's super high. You're probably going to do well when it's super low. That's fine. Just avoid it when it's super high. Or, if you still want to trade, go with a system that will do well with big market moves. In this case, that's a breakout system that historically did fairly well when markets were really active. In sum, recognize your trading style. It's the same. Recognize your trading style. It's just really significant. And the more you understand about your strengths and weaknesses, the more you understand about the mechanics of your own trading, the better you can use things like volatility, or I personally use the FXCM SSI a lot because I think it's great for a trend trader, momentum trader like myself. Adapt to changing market conditions. It's as simple as that. If you know you're going to do poorly, given your trading systems, given that markets are moving too much, then avoid that currency pair. I mean, the data shows it. Intuitively, we know what makes sense. Just avoid systems that are likely to do poorly. And you're not going to do perfectly well, but you'll give yourself a much better chance of success. Range trading, avoid volatile markets. And breakout trading, avoid slow-moving markets. So at the end of the day, I hope to give you a toolkit with which you can say, all right, given current market conditions, I like this strategy because, volatility is super low, the euro continues to hit fresh highs, and so on and so forth, so I'm going to avoid this, but I'm going to do this instead. Take this in sum and really understand your own trading mechanics, so then you can then use things like filters and things like, just general gut feel of the market to really improve your chances of success. And obviously, past performance is no guarantee of future results. Hypothetical performance does have fairly significant limitations, but I firmly believe that if you do look at what's worked in the past, you give yourself a much better chance of success in the future. So with that, I open the floor to questions, and I thank you again for your time.